Today we are going to compare mortgage versus a financial lease as different means to acquire a real estate property. In a previous video, cash purchases were compared with operating leases. In this presentation, three financing alternatives are compared: a mortgage, a financial lease without the purchase option, and a financial lease with a purchase option. The idea is to select which one of these three alternatives is the most convenient one. Recall the different types of leases. Basically, we have two types of leases: operating leases and financial leases. In the operating lease, maintenance and insurance expenses are the lessor's responsibility, whereas in the financial lease, they are the lessee's responsibility. In terms of the cancellation option, meaning the option to stop the contract at any time, this is an option that usually exists in the operating lease, usually once a year or so. Whereas in the financial lease, this option does not exist. As to the purchase option, meaning the option to buy the property at the maturity of the contract, this is not applicable in the case of the operating lease, whereas it usually applies in the case of the financial lease. And finally, regarding the accounting treatment, in the case of the operating lease, rent is treated as an expense. In the case of the financial lease, the accounting treatment varies depending on whether there is a purchase option or not. If there is not a purchase option, simply the present value of the future lease payments is calculated and is accounted for as a liability in the balance sheet, with an asset with an equal amount in the asset side of the balance sheet. The asset and liability go down gradually as the lease approaches maturity. When we have a purchase option, it is assumed that the user of the property will buy the property in the end, and then we depreciate the asset from the start. So the depreciation is deductible for tax purposes. Remember that financial leases are considered an alternative to borrowing, whereas operating leases are not. In this presentation, we will focus on both types of financial leases. First, some comments regarding the financial lease versus a mortgage. When we purchase with a mortgage, interest and depreciation are tax deductible. Also, capital gains or losses apply, and they are affected also by capital gains or loss taxes. In terms of the financial lease without a purchase option, there is no down payment, so because we don't buy the property, and the lease payments are tax deductible. There is no depreciation. When we talk about the financial lease with purchase option, we fix the purchase price of the property at the inception, at the beginning. Then in the future, we will have some future capital gains, usually it's capital gains, not losses, and this will affect it with the taxes, of course. And the option to purchase the property somehow is paid by the lessee by increasing the lease payments throughout the life of the contract. When we have a purchase option, depreciation is deductible, and also the interest portion of the lease payments is also tax deductible. Having said this, tax deductibility in the end might vary from country to country. There might be difference from one country to another. The financing decision must be evaluated by comparing the respective after-tax cost of the loans, explicit or implicit, of the three alternatives. Let's illustrate with an example. Let's assume that we want to buy a property whose value is 2 million, land is 500,000, the building is 1.5 million. We have purchasing expenses of 10% and selling expenses of 5%. This applies to when we buy the property at the beginning and we sell it at the end. Then we have also insurance and maintenance expenses. of 2,000. We have a property tax of 0.10%. We have a rent. The rent corresponding to this property is 550,000 in year one, and it grows with inflation. Also, the value of the property grows at a certain rate, in this case 3% annually. We have an inflation also of 3% annually, corporate tax rate of 30%, and a property discount rate of 12%. Okay, first let's analyze the purchase of the property itself. First, in the colored cells here, what we have is a lot of information that we need to calculate taxes and other cash flows. Basically, we have an inflation factor, the evolution of the market value of the property, depreciation, and the book value of the property over time. Okay, now we start with the cash flows corresponding to the purchasing the property before taxes. So first, we have the amount of cash, $2 million that we need to buy the property. We sell it for $2.3 million in the end. Then we have the purchasing expenses and selling expenses. And finally, we have, the property taxes here, the rent that we save because we bought the property. We also have insurance and maintenance. If we add that up, in the end, we obtain the cash flow of purchasing the property before taxes. So we have a negative cash flow at time zero of 2.2 million, and then a positive cash flow of 543,880 in year one, 560,256 in year two, etc. Well, the next step is to calculate the taxable income and to apply the corporate tax rate to that taxable income. Finally, we add these taxes to the previous cash flow to obtain the cash flow of purchasing the property after taxes. So we obtain a negative cash flow of 2.14 million in year zero, and then 396,934 in year one, 408,416 in year two, etc. So we calculate the net present value of this cash flow, and we obtain 164,243. Being a positive net present value, the property must be purchased. Once we decide to purchase the property, then the next step is how we are going to finance it. And we have these three alternatives that we mentioned before. The three alternatives are the mortgage loan, the financial lease without the option, and the financial lease with the option. The characteristics of the mortgage loan are these. Loan to value 70%, meaning that the loan will amount to 1.4 million. The interest rate is 5%. So if we calculate the corresponding annuity using the French system, we have installments of 322,365. These are yearly installments that contains capital and interest. The payments or the lease corresponding to the financial lease without the option is 220,000 in year zero, and it grows with inflation. And in the case of the financial lease with the option, we have a premium. In year zero prices is 330,000 that we must add to the plain lease of 220,000 to obtain the initial lease payment at time zero of 550,000. And the purchase option is for a nominal amount of $1,000 in year 5. Well, first let's analyze the mortgage loan. Well, first, in the first line, we have the cash flow corresponding to the loan before taxes. We have an inflow of 1.4 million, which is the amount of the loan, and then we have equal installments of 323,365 every year. Next, we decompose the installments into the interest and capital components. We need this in order to get the interest portion, and because the interest portion is the part that is tax deductible. So we know that we can deduct for tax purposes 70,000 in interest in year one, 57,332 in year two, etc. Having said that, we can calculate then the taxes that we save just by multiplying this row this row corresponding to the interest payments. We multiply that by the corporate tax rate, and the taxes that we save will be 21,000 in year one, 17,200 in year two, etc. Finally, we obtain the cash flow corresponding to the mortgage loan after taxes, which is the result of adding these taxes that we just calculated to the cash flow that we calculated previously of the loan before taxes. So we obtain this final cash flow, and then the final step is to calculate the internal rate of return of this final cash flow. And we get that the cost of the loan, the after-tax cost of the loan associated with the mortgage, is 3.5%. Now we evaluate the financial lease without the option. First, we calculate the cash flow of this financial lease before taxes. So we take into account the rent that we can charge to any person who uses the property, the yearly rent, and then we have these expenses, insurance and maintenance, and finally the lease payments. We add them up and we obtain the final cash flow. This cash flow is before taxes, 319,400 in year 1, 327,102 in year 2, etc. Now we calculate the taxable income. We apply the corporate tax rate to this taxable income, and then we add these taxes to the previous cash flow to obtain the cash flow of the financial lease without the option after taxes. Finally, to obtain the loan implicit into this financing arrangement, what we do is that we subtract this cash flow that we just obtained, so we subtract from this cash flow that we just obtain the cash flow of purchasing the property cash after taxes. So the cash flow corresponding to the financial lease without the option minus the cash flow of purchasing the property cash will give us the financial lease without the option, the loan associated with the financial lease without the option. And this cash flow is the one that appears at the bottom. A positive cash flow of 2,140,000 in year 0, and then payments of 173,354 in year 1, 179,445 in year 2, etc. Notice that we have a substantial negative amount in the end of 1.6 million, over 1.6 million. That is because if we don't have the option to buy, we are losing the upside of owning the property for 5 years and being able to sell it in year 5 with a profit. So we are losing this profit, so this is translated into a negative cash flow into the implicit loan. Well, as we did before, we calculate the internal rate of return of this implicit loan and we obtain 2.09%, which is less than the cost that the mortgage cost of 3.5%. So just comparing with the mortgage, this is a better option than the mortgage. Finally, we do the calculations for the financial lease with the option. So first, as we did before, we obtain the cash flow before taxes, accounting for the rent that we can charge, insurance, maintenance, lease payments, and here we add the benefit of the purchase option. In this case, we benefit from being able to buy the property in the end and having a substantial profit. So we have a positive cash flow in the end. And then we account for taxes. First, we have to calculate the interest implied in the lease payments. Okay, so what we do is that we decompose the lease payments into the principal and the interest part. Okay, the interest part is important because this is the part that we are going to use. This part will be tax deductible. So we can deduct for an implied interest of 247,705 in year 1, 212,050 in year 2, etc. We can also account for the depreciation. Okay, so the taxable income will be just the sum of taxes plus depreciation. So we have a taxable income, for instance, of 177,205 in year 1 and 139,055 in year 2. We apply the corporate tax rate to this taxable income, and then we add these taxes to the cash flow that we obtained before taxes. And now then we have the cash flow of the financial lease with the option after taxes. So we have 73,662 negative in year 1, 64,711 negative in year 2, etc. And in the end, in year 5, we have a positive cash flow, a substantial positive cash flow of over 1.5 million, corresponding to the benefit that we obtain after taxes of selling the property, selling the property with a substantial profit because we can buy it with a very low, for a very low, $1,000 in the end. As we did before, we can obtain the implicit loan in this financial arrangement, which is just the result of deducting the cash flows of purchasing the property cash after taxes from this cash flow that we just obtained, the cash flow corresponding to the financial lease with the option after taxes. So we obtain the implicit loan, which is a positive cash flow of 2.14 million in year zero, and then negative cash flows of 475.96 negative in year one, 473.128 in year two, etc. As we did before, we calculate the internal rate of return of this implicit loan, and we obtain 1.4%. So in this case, we see that the financial lease with the option is the less expensive financial arrangement. Before showing the final results, we also did a sensitivity analysis to see how the cost of the different financing arrangements is affected by changes in some key variables. We selected the interest rate, the growth rate in the value of the property, and the tax rate. So we see that when interest rates rise, the value of the cost of the mortgage increases, and the cost of the financial leases is not affected. When the growth rate in the property value rises, the mortgage is not affected. The financial lease without the option, the cost goes up, and the cost of the financial lease with the option to purchase goes down. And when the tax rate increases, the cost of all three financing alternatives goes down. Interpretation. Well, as we said before, the after-tax cost of the financing alternatives are mortgage, 3.5%, financial lease without the option, 2.09%, financial lease with the option, 1.4%. So the preferred financing alternative in this case is the financial lease with the option. Well, this is the most common way to compare financing alternatives, just by calculating the internal rate of return and selecting the lowest one. However, given that the magnitudes of the implicit loans are not the same, in the case of the mortgage, the loan is different from the case of the financial leases, a more rigorous comparison would require using adjusted present value. But we are not going to get into this for two reasons. First, because we don't want to complicate this presentation, and second, because it's very rare that the results that you obtain using adjusted present value will be different from the ones you obtain by just looking at the internal rate of return. So we will ignore this consideration in this presentation. So let's conclude. Three financing alternatives have been compared: a mortgage, a financial lease without a purchase option, and a financial lease with a purchase option. The comparison was made by computing the respective after-tax internal rates of return of each loan. We also prepared a sensitivity analysis to assess the impact of changes in three key variables: interest rates, the growth rate in the property value, and tax rates on the cost of each loan, explicit or implicit. Finally, we pointed out that this methodology, although very popular, is not rigorously correct, since it ignores the fact that the loans associated with the three financing alternatives are not the same. And this is everything I wanted to share with you today. Thank you.